Now, let's take an example on the financial assets measured at fair value through profit or loss. Consider a financial institution that engages in day trading. So day trading means what? Means buying and selling stocks within the same trading day in order to capitalize on short-term market movements. The primary goal is to generate profits from this quick turnaround. So the company is going to purchase stocks for trading. So when the institution buys the stocks intended for the day trading, these stocks are immediately classified as fair value through profit or loss. The journal entry here at the time of the purchase will be debit the financial assets, which is trading securities measured at fair value through profit or loss, and credit the cash with the value of the purchase as we explained before. Now, let's assume that if the stocks are sold for $55,000 later the same day, so this means that there is a gain equal to $5,000. So in this case, the journal entry at the time of the sale will be debiting the bank for cash, but usually it will be the bank for $55,000 and crediting the financial assets, which is trading securities measured at fair value through profit or loss, which was measured at $50,000 in the previous entry. And we are going to recognize the gain on trading securities, and this gain reflects the profit from this transaction with a value of $5,000. So this gain account will be reported in the statement of the profit or loss. So the gain here is immediately recognized in the statement of the profit or loss. Why? In order to affect the institution earning for this period. Let's now take another example for corporate bond designated as fair value through profit or loss. Assuming a company invests in corporate bond and decides to designate this bond at fair value through profit or loss in order to eliminate or significantly reduce an accounting mismatch that would arise if they were classified differently. The company actively manages this bond, evaluating their performance on fair value basis. So at the time of the initial recognition, the bonds are initially recognized at their purchase price, and any subsequent fair value changes are being recorded in the statement of the profit or loss. Now let's record the journal entry for the increase in the value of this bond. Let's assume that we have a value increase in this bond by $10,000. So in this case, we are going to increase the investment in bonds because we didn't sell it, but the value is increased for this investment. So we are going to debit the investment in bond by $10,000 to reflect the increase in their fair value. And then we are going to credit the gain on the investment in bond, and this gain will be reported in the profit or loss statement with the same value, which is $10,000. So as you see, we are marking the investments by day-to-day changes in their value, and for simplicity and for practical application, usually it is being done on a monthly basis. So if the fair value decreases later, the loss is similarly recognized in the profit or loss, directly affecting the company's earning. So exactly like what we did with the gain, you might do with the loss as well. The following mind mapping also summarizes all of the previous explanation of how and based on what to classify the financial assets into each of 3 categories. Take your time to review and memorize it. And as you see in this mind mapping, there is an option for each track before deciding which category of financial assets is best. So let's explain this mind mapping in order to show how to classify the assets or the financial asset into one of these categories. So we will start from the beginning, from the contractual cash flow test. If the contractual cash flow solely for the principal and interest, which means that the answer is yes, so we meet this condition. So we are going to move to the second test, which is related to the business model. And ask yourself whether the business model is to hold this financial asset to collect the contractual cash flow only up to the maturity. If the answer is yes, so here you have an option to classify these financial assets into fair value through profit or loss. And this option is for one-time use at the date of the initial recognition. Meaning that if you didn't take the option now, so you will not be able to return back and reclassify this. So you have an option here. Whether you are going to classify this financial asset as fair value through profit or loss. So if the answer is yes, so you are going to classify it. which is in the group in the middle, which is fair value through profit or loss. So this is how to go through the mind mapping. Then we will start again from the beginning. Go up to the first test and ask yourself whether the cash flow, contractual cash flow, solely represents the payment and interest. If the answer is no, because we considered yes before in the first scenario, but if the answer is no, no here means that the cash flow doesn't represent solely the principal and interest, but may be coming from sale transaction that you are going to realize profit, for example. So in this case, ask yourself, is it equity instrument to classify this financial asset as fair value through OCI? The answer is no, so it will be classified through fair value through profit or loss. What if the answer for the first test is yes, meaning that the contractual cash flow solely represents the principal and interest? But when it comes to the business model is not to hold and collect the contractual cash flow, but it held and collect the contractual cash flow and also for sale. So we have an option to classify this financial asset at fair value through profit or loss. So in this case, if you are going to use this option, so it will be classified as fair value through profit or loss. And if you don't prefer using this option, so in this case, you can classify it as fair value through OCI. So this is how to read this mind mapping and this visual, and how to classify the financial assets into one of the three categories based on the different scenarios.